Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, the market strategist here at Zephyr. You know, when markets are ripping to new highs on a regular basis, the importance of investment risk management can kind of get lost in the shuffle. Well, there is a lot of uncertainty out there that financial advisors must sift through when creating an investment portfolio for their clients. Well, I have on the perfect guest to talk about the importance of risk management, some risk management strategies, and much more. But first, this episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to give a very warm welcome to Dean Smith. Dean is a portfolio manager and chief strategist at FolioBeyond. Dean, thank you so much for coming on. You know, it's such an honor to have you on. I'm really excited for this conversation. I like talking about risk metrics, risk management, and different strategies. So, really excited about this. Can you please tell us a little bit more about yourself and FolioBeyond?
Sure. Happy to be here. Thanks for the invitation. So I have been in the fixed income markets for quite a while. Don't want to say exactly how long, maybe, but more than a lot of your listeners, perhaps. But started working on the street, trading mortgage-backed securities and whole loans, and doing securitizations and CDOs and all that sort of thing. So, it was right there as securitization was taking off, and people weren't really quite
Mhm.
sure what these things were. What does AAA mean? What does triple P mean? And it's because it's a different thing in a structured security than it is for a corporate bond. We can get into that if you like. But after that, moved over to the buy side, had my own advisory firm
Okay.
for a number of years doing complex deals for different hedge fund and private equity clients. Eventually made my way over to a hedge fund called Highland Financial, where I was a partner there in charge of all of our credit strategies. So
Okay.
anything that had any kind of credit risk at all, I was responsible for managing that. And so brought a lot of different tools to that exercise, and we can again talk about some of those
Yeah.
as we get into the conversation. Did that all throughout the financial crisis. Took a small rest after all that turmoil, but
Yeah.
jumped right back in. I've been with FolioBeyond now since we launched about 6 years ago,
Okay.
and came on as one of the original members of the team, chief strategist. And then in 2021, we launched our first exchange traded fund, which is called Riser, RISR. And that fund is a tool to give investment advisors and investors a way to help manage interest rate risk the way
Okay.
that institutional investors do. And we can again get into that.
Yeah.
And then earlier this year, we launched a new ETF called FIXP,
Okay.
that invests entirely everywhere in the fixed income market space. So govies, corporates, munis, high yield, international, you name it. And so that has a lot of different challenges there as well.
Yeah.
So it's been a really fun ride. We've kind of seen a lot of the euphoria and the despair that comes from investing over
Yeah.
long periods of time. But I'm really enjoying it. It's great business.
Dean, that's fantastic. I love it. And you don't have to say how many years you've been in the industry, but all I know is that I love all the experience that you're going to be able to share. When I started 20 years ago in the industry, for a while, especially after the great financial crisis, you mentioned this, when interest rates were so bonds were boring. And maybe even
Yeah.
before that, when yields were falling and, you know, it just was like, yeah, this is kind of boring. Let's do equities. That's changed, Dean. And over the
Yeah.
years, kind of, are we at like over the past few years really a sweet spot, for
Well,
fixed income that we haven't seen in a while?
it's funny. You just reminded me of during Bill Clinton's administration. So we're going back a ways, but we all
Yeah.
remember Jim Carville, the raging Cajun, the political advisor. So back then, the fixed income markets and the government market especially, but fixed income markets generally were like the disciplinarian of the markets. They were the ones who, when things got out of hand, really imposed order and
Yeah.
regularity to the market. And Jim Carville once was quoted as saying, "When I come back, being president's not really powerful. When I come back, I want to come back as the bond market." Okay, because the bond market was what imposed discipline, and
Yeah.
because there was risk management and there was risk control, and people were analytical and quantitative. The equity market that trades on hopes and dreams and aspirations, and people tell stories about this company's
Yeah.
going to disrupt this marketplace. Bonds don't disrupt any sort of thing in the way that an equity can. I mean, look at
Hmm.
Nvidia or any of the Magnificent Seven. Bonds were supposed to be sort of the quiet, uh, as I said, discipline, risk control. That's not the case anymore. I mean, you only have to look at the financial crisis of 2008, 2009, and the
Yeah.
volatility we've seen in the market over the last few years. We went from an extended period of zero interest rates, the ZIRP, zero interest rate policy. We're definitely not in that era
Yeah.
anymore. And there's been a lot of pain in these markets over the last few years. And only some of it's related to the Federal Reserve policy. And I'm sure we're going to drill down
Yeah.
on that as well. But it's a different market than it was 20 or 25 years
Yeah.
ago. The periods when you and I were cutting our teeth.
Definitely. Well, it's interesting too. Um, you talked about the pain, right? And we're going to get into the risk management part of this shortly, but wasn't that pain kind of needed? Because ZIRP, zero interest, that's not normal, right? And that
No.
caused a lot of, imbalances in the market. Now we're normalizing, we're getting, 4% yield, 4.5% yields, which is much more normal than one out that, 10-year treasuries. So isn't I hate to say it, wasn't the pain kind of necessary?
Yeah, I mean, I think so. I would definitely agree with that. I mean, zero interest rates or free money, if you want to call it that, produces a lot of misallocation of capital. Okay. And when money is free, people do dumb stuff with it. Okay. And
No,
so a lot of the, let's just say, malinvestment that occurred over the period of zero interest rates was related directly to zero interest rates. If money
yeah,
is free, then why not leverage to the hilt and sort of take your chances and roll the dice? You mentioned though the more normal. If you go back historically, go back kind of as far as you want. Don't go back to the Civil War, but go back to the modern era. The average rate for the 10-year Treasury is right around 4.5%. It's
yeah,
in that plus or minus. It's
yep,
it's right there, and so the sort of wailing and rending of cloth and gnashing of teeth about sort of where we are in the market right now is pretty ahistorical. I mean, these are not extreme
yeah,
interest rates by any means. Another way to look at it, if you will, is what is the average spread of the 10-year over inflation? It's around 2.5%. Okay, that's
hmm,
sort of the premium over inflation that 10-year Treasury risk has earned historically. Well, what is the Fed's target for inflation? It's 2%.
2%.
What's 2 plus 2.5? We can do that math in our heads, right? It's 4.5. Okay, we are not in an extreme interest
Yeah,
rate environment by any means, and so the people who recklessly, we might say, or carelessly, or through a lack of risk management and a lack of historical perspective, sort of expected interest rates to stay at zero forever. And the people who are expecting them to go back down to zero now, because that's what it's always been, as long as they've been alive. Um, they they had a lot of pain
Mhm.
getting to from zero to here. And if they're positioning themselves now for a return to zero, they're going to have more pain as well. So
Yeah.
people need to be reacclimating, getting their heads wrapped around the fact that we're not going back to zero.
Yeah. At least hope not.
I mean, I'm barring another pandemic or something
Yes.
along those lines. There's nothing on the horizon now
Right.
that we see that should take interest rates back to zero. In fact, many of the things that we see in the world, in the macro economy, in the geopolitical situation, we're going to talk about all these things.
Yep.
They're all tending towards higher rates, not lower rates. That
Mhm.
doesn't necessarily mean that we will retest the highs, but it does mean that if you are looking at sort of opposing forces that are tending towards higher interest rates versus forces that are tending towards lower interest rates, most of that force is in the direction of higher interest rates, or at least not
Yeah.
materially lower interest rates.
Yeah, I love it, Dean. Great insight. Let's talk about some of those risks that you just mentioned
Sure.
that are out there. What are maybe the couple primary risks that you and your team are focused on? There's a lot of wall of worry out there,
Yeah.
potential. Are there a couple that you're focused on more than others?
Well, what's really interesting. We think about this all the time. This is my job. you know what are the risk factors that are out there that I need to be concerned about, and I need to help advisors work work through with their clients. Um, Remember, it's more than a few years now, but the movie Dumb and Dumber.
Yeah, I
We all
love
remember
it.
that with Jim Carrey, and towards the end he finally meets up with, I think her name was Mary in the movie, right? And he's saying, "Do you think a guy like me and a girl like you could get together?" And she says, "Not likely. Maybe like one in a million."
Yeah.
So he says, "So you're saying there's a chance?" That's the way the bond market is trading right now. Okay. Everyone knows that there are these big risk factors out there. We're going to talk about them specifically. But every time there's a tiniest little bit of good news, they run out and buy bonds. Okay. Sometimes it even happens intraday. In the last
Mhm.
2 weeks, I have seen at least 4 or 5 days where the tendency has been towards a sell-off in bonds. Some tiny little sliver of news comes out, and all of a sudden we rally a half a point on tens. And it's just like, this is not the
Yeah.
way the bond market is supposed to work. So, what are these big risk factors that are out there? First of all, we've had a bunch of news today on tariffs. Okay, tariffs are a big one. They're a big one
Yep.
in my view, and more importantly than my view, they are a really big factor in Jay Powell's view, the head of the Federal Reserve. Okay, he mentioned tariffs. He testified in front of the House and in front of the Senate 2 days in a row earlier this week, and he must have mentioned tariffs 100 times. Okay, the tariff situation, as chaotic as
Mhm.
it was rolled out on Independence Day, April 2nd, and
Yep.
then taken back off the table when bonds, I was going to use a profanity, I won't, when bonds behaved badly, was taken off the table. They 9 days later on April 9th, they said, "Oh well, we're going to push those. We're going to push those off into the future."
Yeah.
And it's been a roller coaster ever since then. On that, here's the reality: tariffs are inflationary. Okay, you can talk about who exactly pays them. Do consumers
Yeah.
pay them? Do corporations pay? They are a tax on consumption. Okay, that's inflationary. And this morning, you had Howard Lutnick come out and say, we're close to deals with everybody. And the market rallied. Market
Yep.
rallied. We were down 14 or 15 ticks on 10 years this first thing this morning, and now we're about even, I guess. So we rallied
Yep.
a half a point again. This seesaw ride. Well, just before we got on this conversation here, I checked again. Trump just threw whole cold water all over that, and Scott Bessent threw cold water all over that. So, this volatility in policy and the
Yeah.
idea that this tariff situation is going to be wrapped up. I think the deadline is July 9th, right? That would
Yep.
be
It is.
90 days after the April 9th, right? So the idea, the notion that this is all going to get wrapped up by July 9th is just nuts. It's just nuts. It takes years to negotiate trade deals. So
Yeah.
what they're announcing now is the same thing that they announced in Geneva a few weeks ago. What is happening between the US and the EU, the US and China, is an agreement to talk about agreeing.
Yeah.
That's all it is. Okay. There are no trade deals that are actually being worked out. These trade deals run to thousands of pages and they're very
Yeah.
technical. What is this kind of metal? What is that sort of agricultural commodity? What kind of wheat? What kind of corn? These things don't get wrapped up by Howard Lutnick and Scott Bessent over a weekend in Geneva. That's
Yeah.
just nuts.
Yeah.
So this tariff situation and the uncertainty over this is going to be with us for a while, unless Trump just completely caves and walks away from it, which I don't think he's going to do.
Yeah.
He's been talking about tariffs for 25 years.
Yeah.
Okay,
No.
so Howard Lutnick and Peter Navarro and some of the people he has on his team, I'm sure they're nice guys and they don't cheat at golf, but whatever. they don't know what they're talking about. Okay, these are going to be difficult negotiations, in particular with the EU. Okay, our trade volume between the U.S. and the EU, the gross flows, inflows and outflows, are double what they are between the U.S. and China. Okay, it's about 600 billion
Mhm.
with China, give or take, and it's like 1.1 trillion with the EU. And there's 27 countries in the EU that have
Yeah.
to agree. Brussels just can't snap their fingers and say, "Oh, we got a done deal here." So tariffs are a big risk factor out there. Okay, you've got this big beautiful budget. That's not the name I would give it. Or the big beautiful bill, excuse me, big beautiful
Bill, yeah.
budget bill. Right. It's not the name I would have given it, but that's the name that it seems to have. It squeaked through the House, and it's in real trouble in the Senate.
Yeah.
Okay. Even if it passes in something like its current form, the debt and deficit implications of this bill are staggering.
Yeah.
You can think it's a good policy, you can think it's a bad policy. I'm not making a political judgment about the merits of the provisions of the bill. People can differ on those things. As an investor, I don't take a view on whether this is good policy or bad policy. All I do is look at the numbers and I'm saying, if this bill passes anything even remotely close to its current form, you're looking at massive increase in debt and deficit.
Yeah.
Okay. So you got that factor out there. You've got, the situation in the Middle East and in Ukraine is still extremely volatile. The fact that, we weren't even talking about Iran 3 weeks ago.
Yeah.
And now
Right.
we've apparently fought and resolved a war that wasn't even on anybody's radar screen 3 weeks ago. Leave that aside. You've still got a horrible situation in Ukraine. You've got a horrible situation in the Middle East. And,
Yeah.
I don't know how that gets resolved anytime soon. I'm not a geopolitical analyst. I can
Yep.
read the papers.
Yeah.
And, there are just so many issues like this that really cause you to wonder why people think that Morgan Stanley last week, and not to call him out specifically, Morgan Stanley last week said inflation for 2025 is going to run at 3.3%. Now, depending on what number you look at, somewhere
Yeah.
between 2 and 2.4, 3.3%. And oh, by the way, the Fed's going to cut 7 times next year. It makes no sense. It makes no sense, the way that people are looking at these markets. The Federal Reserve had their meeting a few weeks ago, right? The dot plot comes out. For
Yeah.
those who don't know what the dot plot is, it's a a list of how many cuts each Fed governor or each member of the open market committee thinks is going to happen this year. The number of people expecting no cuts in 2025 went from 4 to 7.
Yeah.
The number of people expecting one went down by, I believe it's 2. The number expecting down by 1, and the number expecting 2 went down by 3. This is a very bearish dot plot.
Yeah.
And yet people are acting, and the markets are acting like, because Waller says on CNBC one morning that, we could see cuts in July, that everything's good. This sort of, volatility trading on intraday on little news things like this is not typical of, this is not your dad's bond
Yeah.
market. So people who are in the business of managing risk in fixed income portfolios or blended portfolios need to really rethink the way that fixed income risk needs to be managed.
Dean, that is fantastic. First of all, a lot to unpack there, but first of all, you are the first one to reference a Dumb and Dumber, the Dumb and Dumber movie on the show. You're the first one. Never happened before. That was fantastic.
I'll probably get started on pop songs later. I have
Yeah.
lots of pop song references too. Yeah.
That's fantastic. But it's so much going on. And it's just all that, like you mentioned, the Fed. There's such a division now within the Fed officials, the FOMC. Like, how does somebody like you, financial advisor, take that division and just uncertainty within the Fed and try and manage risk? What are some risk strategies that like a financial advisor can use, or is it just diversify, which is boring, but
Yeah. Well, diversification is part of it. The way that people used to manage fixed income risk, and many still do, is it tended to be sort of a fund it and forget it kind of
hmm
approach. So let's take sort of the classic 60-40 portfolio, right? They would take 60% of an investor's portfolio and put it in equities that were to some extent actively managed. The advisors trying to, add value by picking sectors or picking stocks or whatever. And then the 40% bonds would either be just sort of static or in maybe some laddered maturities,
yeah.
have something in 2s, something in 5s, 10s, et cetera, just kind of laddered out there. And as we have seen now over the last few years, certainly since the great financial crisis, is that static approach doesn't work.
hmm
You have to be more, I'm not saying you need to time the market, because you shouldn't be trying to time the market. No one can time the market. I can't time the market. You can't time the market. But what you can do is you can set a risk budget. Okay, say, how much risk am I willing to take in this portion of my portfolio overall?
Yep.
And what's the contribution, and how much risk am I willing to accept in my fixed income sleeve? Okay. Now, there's lots of ways to manage risk, to measure risk. The sort of classic way was, just looking at volatility.
Yep.
Just look at the historical returns and have to, pop it into Excel and compute the standard deviation or the variance, and that's sort of your
Yep.
volatility. That is a way to do it. There's lots of historical reasons, academic reasons as to why people looked at things in that way. I don't necessarily think it's the best way. It's certainly a starting point.
Yeah.
What it does is it gives you an apples to apples comparison across different products and different sectors.
Yep.
Okay, so great. It's a great measure to have. You should know if your volatility in terms of standard deviation is 5% or 50%. You need to know that. A better way, or sort of a more nuanced way to look at it, is drawdown risk.
Yep.
How much can this portfolio lose, and under what circumstances? Okay. how much of a drawdown can I have, and what would be the sequence of events that would lead that to happen? Okay. So, if you have a 60-40 portfolio and you've got an ability to take losses because of your investors' time horizon or risk appetite, whatever it might be. We're not going to be able to get too detailed into this in this conversation. This is
Yeah.
a complex topic, but you can say how willing am I to have this investor risk a 5% drawdown in his fixed income sleeve? Okay, what would cause that to happen? Well, he owns X% of 10-year duration.
Mm-hmm.
That's the interest rate sensitivity of a bond, right? So if interest rates went up by, 50 basis points, how much would this investor lose? And it's not that difficult a thing to compute. And we help investors with this. We run scenarios for advisors all the time. And, that is, it's not as it doesn't seem to be as scientific as computing a variance in an Excel spreadsheet,
Yeah.
but it's a much better way to look at it because it's much more intuitive. It it connects the investor's risk appetite with the kinds of events that could cause loss. That's a really good way to think about things. The other thing that you need to really consider carefully as an advisor is the extent to which your your portfolio is diversified or not diversified. And so what that means is obviously how correlated, how likely are things to move together, and under what circumstances would they move together? So, for years, for a long time, the reason that people included fixed income, or one of the reasons, was that bonds tended to zig when stocks were zagging. And so it kind of balanced out things. That's not nearly as common an outcome anymore. If you look, I just did an analysis for somebody recently. If you go back over, I think it was the last 10 years, but I should be off on the details. It doesn't matter. But I was looking at quarterly uh, uh, periods where stocks and bonds moved differently or in the same direction.
Yeah.
And it's now about a 50-50 chance on a quarterly basis that stocks and bonds will move in the same
Wow.
direction. And so I went back, I think it was 20 years, I think I went
Yeah.
back and looked at how that's changing over time. So you need to be much more nimble in your
Yeah.
fixed income allocations than once upon a time you could be. And you need to be thinking about, as I said before, what are the things that could happen that would cause this drawdown to occur? And then the most important thing, and I have this conversation with people all the time, is it's great to have a view. Okay. I think the Fed's going to cut rates. I think stocks are going to continue to rally. I think the tariff situation is going to get resolved. Okay. What if you're wrong? Okay. No one has a crystal ball. No one can see the future with perfect clarity. I certainly know I can't. I'm assuming you don't think you can.
Yeah. No.
Okay. So you need to step back once you sort of set out your view about the market, whether it's over the next 6 months, 2 years, whatever it might be. Step back and say, okay, what if I'm wrong? What are the vulnerabilities in this outlook? How do I protect myself, or what should
Yeah.
I be watching to see if my thesis is starting to come apart? Because what happens sometimes is you fall in love with your forecast. Okay.
Yeah.
And you say, I think X is going to happen. And you think X is going to happen because that's what you want to happen, not because you have sort of any really well-founded belief about why X should happen, but because it would be good for your portfolio if X happened. And so that is a real danger that investment advisors need to guard against, is don't fall in love with your forecast.
Yeah. That's fantastic, Dean. Great insight. And love that you talked about the history of risk. And I could not agree with you more about how, standard deviation's great. It's an apples to apples comparison, volatility. But I'm sorry, Dean, give me all the upside volatility
Yeah,
you want, right? It's a downside volatility. And, the team at Zephyr, we've done a lot of research on downside risk and the importance of managing that because to me and the team, that's the real risk of investing, losing my money,
right.
right?
Yeah.
Losing my
Yeah.
money. So we've done a lot of risks. So I'm really glad you brought that up because managing the drawdown risk is a lot more important than just managing volatility, I think.
Yeah. Warren Buffett only has two rules for investing, at least that he's shared with the world. The first rule is don't lose money.
Yeah.
The second rule is go look at rule number one.
Yeah.
Okay.
No, and
Losing money is tough to recover from. Okay. If you can minimize your drawdown, you are going to be okay. Okay.
yeah.
You don't have to be invested in the Mag 7. You don't have to time the market perfectly. You don't have to, be in the hottest stocks or the hottest IPOs. Avoid drawdowns.
Yeah.
Okay. And one of the things that, the products, and little self promotion here, one of the things that the products that we have brought to the market are intended to do is exactly that, help avoid drawdown.
Hmm.
Okay. So if, and we people are talking about this, probably on your podcast previously, but the math of drawdowns is brutal, right?
Yeah.
Right. If you because to recover, I'll give an extreme example, but if you lose 50% to get back to even, you need to gain 100.
Yeah.
Okay. And that math, does it's not as dramatic, but even for smaller drawdowns, 10%, 15%, 20%, the math is still pretty rough. And
Yeah.
so avoiding drawdowns, avoiding loss is, that's as a investment advisor, investment manager. And this is it's interesting. This is the way that institutional investors think about things. Okay, retail investors sometimes don't think about things in this way. They think about finding the next hot stock, getting a stock
Yeah.
tip, getting whatever it might be. As an investment advisor, you should really not do that.
Yeah.
It's just not good. Your job should be managing risk.
Yeah.
Don't let your customers, don't let your investors get out over their skis. Don't let them take risks that they don't understand or that you don't understand. More importantly, so these kinds of things
Yeah.
are what separates really talented uh, investment advisors and asset managers from those who just are along for the ride. And if you don't have those skills, you can pay
Yeah.
for it, right? There are risk management tools and people that you can work with. And if you're part of a bigger platform, they provide tools to do these things for you. Now, in some cases, it's going to be the old style, you know,
Yeah.
mean and average and standard deviation kind of thing. And if that's all your team or your platform is able to provide for you, then you need to find better people for your team or better tools out there in the marketplace.
Yeah. Fantastic, Dean. A great way of wrapping this conversation up. Like I said, at Zephyr, we do a lot of analytics on drawdown risk and examining it, and I do a bunch of research on it. And really, like you said, at the end of the day, it's um, win by not losing, right?
Right.
Just win by not losing, managing that. Where can our audience find out more information about those portfolios that you manage that help manage fixed income risk and overall portfolio risk and about Folio Beyond?
Yeah, go to the website. It's foliobeyond.com, all one word, foliobeyond.com, and all the information is there. There's a link to specifically look at those ETFs, RISR and FIXP. All of the disclosure information is there. All the historical performance information is there. And if you see something that you have questions about, shoot us an email. Someone will be back in touch with you, I promise.
Fantastic, Dean. I love the conversation. It was an honor to have you on. An audience, yeah, leverage Dean and his team. They have a bunch of insights on, risk management, especially in the fixed income side. Like Dean said, it's evolving now. You just can't buy it, let it sit. And it's a lot more complex going along you know, diversifying duration, credit, regional, a lot of those stuff there. Dean, thank you so much. Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. And please be sure to follow or like, subscribe to those channels, and follow us on LinkedIn. Thank you, and have a great rest of your week. Dean.